Um, Introducing our next panel, markets are hard to read, and there's no shortage of confident advice that turns out to be worth zilch. This panel will bring Howard Wilcox to the stage, Anish Lal and Greg Smith, three people who watch markets closely and back their views with their own money. Honest takes on where the real opportunities are, how to weigh risk, and how to hold your nerve through a volatile year. Please welcome Maria Slade from Business Desk, who will be hosting this next panel, our panelists, and we'll do the introductions. Thank you. They're all on. You've just, yep, you go on and I'll manage it. Cool. Yeah. Thanks, guys.
Interesting. Great. So look, as mentioned, my name is Maria Slade. I'm a journalist with Business Desk. I mostly cover property, actually, markets, so sort of not so much my thing. So I've been very much interested in hearing some of the discussions this morning, and we're looking forward to continuing that now with Howard Wilcox, of course, from Tiger Brokers, Anish Lal, who you've just heard from BlackBull, and Greg Smith from Generate. So look, again, there's been an awful lot of talk this morning about trends and, you know, with volatile markets at the moment, with whatever Donald Trump decides is the truth on the day. I'd like to come to each of you maybe, and Anish, you actually sent me some thoughts on this, you know, reacting to macroeconomic shocks and sudden sentiment shifts, FOMO, you know, traders thinking that, individuals perhaps thinking that, oh my God, I've got to suddenly buy, you know, SpaceX or whatever it is. For each of you, what's the single biggest thing that you're paying attention to at the moment, and why? What's something that's getting a lot of attention and you think is overhyped, and conversely, maybe something that's flying under the radar. So Howard, if I could perhaps start with you.
I was hoping I'd be third. Something that's flying under the radar, excuse me, I think getting back to basic manufacturing stocks. There's not a lot of, I mean, they're boring. But, you know, making a widget for $1 and selling it for $1.50 is always good business. So I think those have been overlooked. You know, we talked about SpaceX, and it's been mentioned a lot, and it's exciting. And I think Anish, you said, well, you know, it's come down a lot because it's sexy. You know, SpaceX is sexy. I've got SpaceX. If you look at the concept behind it, it's a great concept, but it's going to take a while for it to work. Whereas if you've got a manufacturer that's making widgets, he turns them out every day. Yes, he's got to sell them, but you're looking at a basic business that's not relying on hype.
Okay. Anish, you've been talking about some of the things that are overhyped and some of the things that you're paying attention to. What would be your biggest overhype at the moment?
So I don't know if anyone has access to or has heard of the DeFi markets. So the DeFi markets actually allow you to trade assets like SpaceX on a weekend based off of a US dollar tether sub-denomination. Essentially what it allows investors to do is get into a weekend market price and trade SpaceX out of hours. You can do the same thing with gold. You can do the same thing with crypto. Traditionally, markets were Monday to Friday. If you're in Europe or New Zealand, it's, Sunday to Friday. If you're in New Zealand, it's a Monday morning to Saturday morning. But now it's completely changed where it's 7 days a week. Unfortunately, we have to staff our offices on the weekend now. And pay Sunday rates. I don't know. But essentially, I guess going back to your question, what is overhyped are a lot of the new asset classes, in my opinion, that are coming out. And it's becoming quite complex. But also, you're seeing individuals dictate asset movements. For example, Michael Saylor, who runs MicroStrategy and STRC. Essentially, he sold 32 Bitcoins about a month ago, and the price absolutely plummeted. He sold it to pay out dividends, essentially for MicroStrategy because he's in a $12 billion loss at the moment across all his portfolio. Now, that sentiment shift sent waves through the market and sent the price of Bitcoin crashing. What we have seen is very much an institutional adoption into crypto asset classes, especially with the BlackRock ETF, which has risen at an exponential rate, overtaking the gold ETF that they offer. But essentially what this means is that markets underlying are extremely sensitive, and that the beta on the sensitivity is what's driving volatility. And from my take is that any single shift from individuals can be enough to crash an entire market. For example, Michael Saylor selling 32 Bitcoins, which is a minute amount of BTC.
Gosh, that's scary. Greg, for you, what's your overhype and under the radar?
Yeah, I've got bits of both of the chaps' ideas. I can actually steal those being going last. But yeah, obviously SpaceX is the big one. Yeah, a lot of hype around that. It's got a really profitable business in terms of Starlink, but it's investing elsewhere. Lost $5 billion last year. I think it's a $2 trillion company. A lot of FOMO with the retail offering. I think if you'd bought the average 5-day VWAP is actually around about where the price is now. So, it shot up and back down, so it's about flat. In the next 3 months, there's going to be a bunch of insiders that are going to be selling their shares potentially. Elon Musk is a trillionaire, but there's 4,400 SpaceX employees, which are now millionaires. They'll be wanting liquidity events in the next 90 days. Beyond that, who knows? I mean, I actually wouldn't bet against Elon Musk. I mean, he's done some amazing things. He's fantastically smart. People laugh when he says he's going to put people on Mars, but I actually wouldn't bet against it. Whether it will happen in our lifetimes is another matter. But 110 times revenues. It's probably a bit expensive. So certainly a lot of hype there. It's going to be really fascinating to see. We've got a bunch of other new IPOs coming potentially as well. So we've got Claude owner Anthropic. We've got ChatGPT owner OpenAI. So it's going to be a big test of investor appetite for these big names. So they're potentially $trillion companies. So certainly a lot of hype around there. On the other side, I think if you look at AI, and Nathan made some of these points. There was a point about cash flows. I think someone said earlier that the market's expensive. I mean, when you're judging whether something's expensive or not, you always need a bit of a benchmark, I suppose. If you look at it in traditional measures, the S&P 500 is expensive relative to historic multiples a little bit. But you've got the tech sector growing at around about 40%. You could actually make the case that NVIDIA at 20 times earnings is cheap. It's growing at 60, 70%. So it'd be fascinating to see whether that's I feel like that's sort of flying under the radar in plain sight. But other stuff, and Howard sort of touched on this, I think is more boring companies. As the economy generally globally is going pretty well. Hopefully, fingers crossed, we're going to end to this the conflict being signed tonight. I guess it is in Zurich. That's going to be really fascinating. Oil prices they're not rising, they're falling. They've gone from $120 to $80 if you look at Brent oil. So that's been a bit of a handbrake potentially on their global economy. So do we get those more boring businesses that have lagged? Nathan mentioned waste. Global waste volumes are going to grow 70% by 2050. We've got to get better waste recycling, waste to energy that works in with the AI. Thematic healthcare. We're reading a great book at the moment, just talking about how a lot of cancers and so on, about the advancements that AI could really help with. Nathan touched on it with testing, so I think healthcare is a great one. And the other sort of big, and we're not a macro house, but I think it would be really interesting to see how the central banks sort of react over the coming months. We had the Fed meeting, and they've put rates on hold. Donald Trump, he wants his man to get rates lower. Do we go back to that? At the start of the year, they were pricing in 2 Fed cuts this year. Then it moved to 2 hikes, I think, almost. So now oil's come back down. Hopefully the conflict's end. How do central banks react? And I think it's going to be really relevant in New Zealand as well. Our own central bank has said they'd look through that oil price spike. Oil has come back down. Our economy, it's not quite in the can, but it's not in a great place. So do we see interest rates maybe even fall here? Yeah. And I think the commercial banks have got way ahead of themselves. So you look at all the major banks, they've been jacking up rates. This is relevant, of course, to all investors, property, equity. Yeah. Do we see that sort of come back? So certainly got an eye on that.
Yeah, great commentary there. Look, we've got, you mentioned your firm, the sort of thing you do. We've got three very different types of investment firms here. You know, you're an active broker, you've got a CFD and Forex a specialist, and a long-term fund manager. I love this question. This was the one that the MoneyHub people sent to me, so I really want to put this to you. What does your discipline get right that others miss, and what do you envy about the others in your approach to investing? Go on, Howard. Not a easy question at all.
I think as an industry, I think what we get right is the pricing. We are an electronic platform that does offer a really competitive price for investors, makes it easy. I think probably what I envy is, and this will be contentious, is the leverage that Anish's platform provides. We do provide leverage. You can buy shares with Tiger on leverage. It's 4-to-1, as opposed to a CFD, which is a different product for sure. But you can do 200-to-1 or 300-to-1, 500-to-1. Not that much, no. But so I mean, but you know, having said that, leverage is you've got to be very careful with it. But yeah, I think that is for us. I think we're pretty happy where we are sitting with our leverage levels because it is a different product. But you know, it's something that I look at.
Okay, what about you, Anish? What do you think?
We invest a lot into technology infrastructure, building our own technology as well. I think that's a very useful point of difference. Where a lot of industry players rely on third parties, and there's a lot of risk with that as well, especially with data sharing. But going from building our own client portal, our own CRM, and in addition to that, building our own crypto exchange as well through partners like LMAX and Milford, who've invested in our company over the years. In addition to that, we've invested a lot in actual server mechanics. So when you place a trade traditionally from New Zealand, you're going to have to connect to trading servers in New York, London, or Tokyo. But we route people directly from the trading server rack by almost copper wire into the actual bank engines, which give under 75 millisecond trade execution times, which is quite unrivaled. And essentially what that means is if you're actively trading, you want to get in at the price you see at the screen, you want to get in fast, and our aim is to execute you as fast as possible. So I think in terms of technology infrastructure, investing back into our product has been quite successful over the last 5 or 6 years. And in terms of what the risks that are posed to our industry is, volatility can go both ways. We're heavily dependent on central bank movements as well. If anyone remembers the SNB crisis of 2017, where essentially the Swiss franc was pegged to the euro at around 120, and that peg had always sat there. A lot of traders held positions at 120 just as a hedge, essentially to buy your Swiss against the euro, and that hedge had been a traditional, very safe play trade. You'd earn a positive yield on the carry trade on it. But overnight, the Swiss National Bank decided to depeg their currency in mid-February sometime of 2017. It was around 2017, and that caused huge amounts of traders on leveraged positions to go into negative territory. Now, negative territory is where no one wants to be on leveraged trades. It means you've got negative balances, and and it was a totally unexpected macroeconomic event, and that caused brokers like FXCM, who you mentioned, Howard, to go under. Alpari, if anyone follows football, they sponsored West Ham, and then the very next day they had no sponsor on their T-shirt because their business was defunct. They went into big liquidation. Jefferies in New York had to take over their business. And so the risks that are posed to the industry from big central bank moves are quite apparent to us. However, saying that, at the time we worked with a Swiss bank, and they informed everyone, hey, heads up, this might happen. It's really in the industry, it's about who you know and how you can manage your risk and how you can adapt to that over time. Of course, the Swiss banks aren't going to let their institutions fail, so it gave everyone a heads up and they were able to mitigate it in advance, but other companies weren't as fortunate. So that's one of the risks, I would say, for the industry.
That's a good story. Greg, you're the more staid long-term fund manager down the end there.
Yeah, well, I mean,
How
in
would you
terms-
answer that?
Yeah, I suppose leverage has come up a bit, hasn't it, today? So I suppose that's maybe not quite envy, but it's certainly a point of difference. So leverage comes with risks, and I guess if you could put risk management plans in place, and that can work well, but it also takes away the fact that of time being your friend, which I think what you get with long-term investing. And it works, and don't just take, we all say that our process, I don't think it's a binary answer either, by the way. It has to sort of be appropriate to your own situation. But long-term investing works. Yeah, the average return to the stock market, S&P 500, is around about 9% over 80 years. Property is 7%. The differences of property, obviously, leverage, and the guys earlier sort of talked, and girls talked about that. So that's certainly what helps there. But yeah, long-term investing works, and yeah, that time ability as well. And you can also, things happen in markets, right? We've had so much stuff happen in the last sort of 5 or 6 years, pandemic, Ukraine war, war in Iran, etc., tariff war, the big trade board that he held up. But stuff's happening all the time in markets. Go back 100 years, go back 200 years. And the beautiful thing with your long-term investing is the market goes up over time. There's always periods when the market has corrections, but over a long-term period, the market goes up. And just draw a chart of the S&P or any index you like, and that's pretty much. So I think that is an advantage, and you can use those periods where there's a drawdown, like Nathan was talking about. 10 to 20% drawdowns aren't common, but they happen. And so you can use that period, to react. So, what Generate we're doing, we managed just under 10 billion. You had obviously Trump announced the US go into Iran, and the market, had a pretty bad March. So, we're active managers anyway, but we were active on steroids during March, and that sort of paid off. We had a 15% positive month in April on the back of that. We had a 7% positive month in May. So I think that's what you get. Being able to, you've got the sort of the timer isn't necessarily on. When you're long-term investing, you can react to those sort of periods. And we're focused on companies, focused on cash flows. That's another word that came up as well. Yeah. Where I think when your time frame is narrower, that comes less into it.
Okay.
And there's an old thing about and leverage as well. There's an old sort of saying about the market can be wrong longer than you can stay solvent. I think that's relevant, but obviously you bring risk management into it.
Yeah, that actually dovetails very nicely into the next question, and I always love putting this question to to people in your trade. What's active versus managed? If you were going to speak to the average, Kiwi investor who's thinking of dipping their toe in, how would you explain the difference and the pros and cons? I might start with you, actually, Greg, since you've already been discussing.
Yeah, so, and we're talking sort of DIY versus using an active manager. Is that sort of the question as well?
Well, also between active and managed funds too, I think,
Yeah, so I suppose it's been a big thing that sort of happened since the pandemic and the advent of Sharesies and Robinhood, and, people thought, DIY investor, that was the new thing, right? But it's really an old thing that's been around for a long, long time. So, look, again, I just like going back to numbers. I think with JP Morgan did a study, and over 20 years, DIY investors underperform the benchmark by 3%, not even an active manager. Look, and I think, so again, it's personal choice with an active manager, whether it be a trader or a long-term investor. There's fees. We have a business to run, so you're going to pay a fee. What I encourage people to look at is the return after fees and the track record. And I think that's the best thing you can sort of do when you're making a choice, and also make sure that strategy is right for your situation. There's another debate as well, I suppose, the proliferation of ETFs. It's brought up the argument of passive versus active investing, and there's, again, I think passive promoters would say that an average manager won't beat a passive strategy. That's actually probably right. So, but that's when it comes into are you with the right manager? Because what is sometimes left out of that argument is the top quartile of active managers more than earn their fees, if you like. And in fact, I think they deliver an average alpha of around about 3.5% to 4%.
Okay. You're nodding sagely, Anish. What is your view on this?
We're seeing more and more people become their own active managers, essentially picking stocks that resonate with them. For example, if we do shows, if you like McDonald's, you know, instead of buying a Big Mac, you can buy a Big Mac stock. Oh, sorry, a McDonald's stock. If you don't like EV vehicles, you can sell Tesla. It's just really about making it fun and investing for you in your own language, and you're seeing more and more people do that. And you've had great success stories come out of New Zealand. We find Kiwis to be extremely patriotic with Kiwi companies too, the likes of Xero and Rocket Lab, who have all started their journeys here, have gone on to do amazing things. And hopefully there are more companies like this that come onto the scene, because it's a market that's hungry for new businesses, it's hungry for technology, it's hungry for investment and investment back into the country. And I think the more and more people that become actively investing in the markets will be able to pick their own trends or their own stocks based on their personality or their own interests. For example, I gave that the AI ChatGPT scenario from my own personal experience, and that helped me pick a basket of stocks. So the access to information is there. More and more people are becoming active. In terms of a managed portfolio, of course, it's like you said, it's a very binary decision. It's really a personal choice. You can be as informed on a company or a basket of stocks as can be, but ultimately you might not have the strength to pull the trigger, so you can let someone else manage your money. Again, it's really a personal decision. There are a lot of good fund managers out there, or you can just look at, say, what the Milford Active Growth Fund is doing and just copy that and take out the stocks that you don't like. So there's lots of options. You can pick and choose how you play your portfolio. I personally think it's really just a balance between two. Perhaps you can have an exposure to both to see which you like, but there's definitely a trend of more active investors. And then with companies like MoneyHub, for example, providing resources and other educational hubs to help you access information, like Howard was showing as well with the Tiger Broker information that you get on the platform. Access to information is there. It's just about accessing it, understanding what works for you, what works for your risk appetite, building a portfolio and going from there.
Yeah, well, I guess, you guys wouldn't be here if there wasn't a big rise in active investing. Howard, what's your view on this?
Look, I will reiterate the other the comments the other two have made. I think if you're going to be an active investor and you're going to manage it yourself, be active. If you're going to be an active investor, you need to be engaged in the market. Especially if you're trading currencies. As an ex-currency trader, it's not something you can put in the bottom drawer. And if you're actively trading a share portfolio, you need to be looking at it, not my comment, getting up at 1 a.m. in the morning and doing it, although we have customers that do that, but actively manage it. So you're aware of what's going on, you're aware of how the market's changing, and you make changes to the portfolio you have.
Look, the markets have been so hard to read in the last 18 months. We get crazy times, but it seems to have been particularly crazy just lately. I'd really like to hear from each of you. What's been the biggest surprise to you personally, maybe in the last 18 months or so? And what did you learn from it? We'll start in the middle, actually, Anish.
So the biggest thing, I guess, over the last 18 months has been the rush to safe haven assets. What we've seen has been a great appetite to pick up safe haven assets as a general fear trend emerges among investors, where they're seeing things might turn sour. So what can I start to pick up? And that's assets like traditional gold, silver as well, and there are cases, especially with that unprecedented rise in silver prices, went up to $120 a troy ounce, from what was somewhat a very stagnant moving metal. People gathering all their silver cutlery, for example, in their kitchen, trying to pawn it off, and lines outside
Truly.
the pawnbrokers to try and sell off their silver. So there's you're seeing a rush to safe haven. I think fear is probably at the highest level that it's been, and that's the fear of the unknown. Whether it's property, whether it's stocks or managed portfolios, are we at the top of a bubble? Vincent at the very start of the summit painted a beautiful metaphor of the Queenstown, the mountain ranges behind us, the peaks and the troughs and the extended peaks, and then with every rise there's a fall, which was said earlier as well. When does that fall happen? We've seen. We're living in a period of quite unprecedented economics, where we've had infinite amounts of money printing, and that still exists. Where does this money go? Well, ultimately, it flows back into equities and infrastructure. That's one of the reasons why we're having these extended periods of gains and gains on gains on gains in equity markets, especially with those 7 big tech stocks and the AI companies and subsidiaries of that. And then essentially the question begs is, when is it too much? When is it enough? Will there be another war? Of course, we're in a very sensitive geopolitical state with China and Taiwan as well. That's very much in the news. Everything that's going on in the Middle East and Russia, Ukraine. As it's been mentioned a few times, we live in quite a very uncertain geopolitical state. And as we saw with the Strait of Hormuz closure, the travel routes quickly changing. I have friends who import materials from Europe and are suffering to this day from delays in shipping, insurance costs rising, everything, all of the above are risks, and they're quickly priced into markets. But how do people react? They react by flocking to safe haven assets. So we could definitely see a more appetite to build that. And Trump, of course, has been talking about auditing Fort Knox, and it's not been done yet. So no one really knows how much stock that is sitting there, and it could be absolutely nothing. Yeah.
Howard, what do you think? What's really surprised you, perhaps, about human behaviour, market behaviour?
I'm constantly surprised. I think a couple of things that I don't know whether they concern me, but that's probably the wrong word. They interest me. Is one, as Anish says, we've got multiple geopolitical problems going on in the world. As I said in my talk, we've got 2 world wars, we've got uncertain political leaders in major countries. Normally we have one of those. We have a war going on somewhere, we have a political leader that is going off-piste, so to speak. We don't have all of these things happening at the same time, which I think is a bit of an issue. However, I am surprised. The markets have been very strong, certainly driven by a very narrow sector of stocks, which is also a concern, but they've been resilient. And I am quite surprised at that. And we saw that with Trump. He said he had an agreement. Whether he has or not, I don't know, but that's irrelevant, because all of a sudden oil was down, the markets roared back into life, and you sit there and you go, wow, that's pretty amazing. I didn't sort of get that. So I think some of the old norms, and we used to have, Anish was talking about the gold price, and back in the day, there was a problem, the gold price would go up, and it did do that for a short time here, but those links, and the US dollar would go up, those links are now gone. So I think I guess we're in more uncertain times than we've been before.
Greg,
harder to pick.
What do you think?
Yeah, I suppose you just
I was interested in what Nathan was saying too about property didn't pan out like you thought.
Yeah, I mean, again, and that was his peaking interest rates thematic, which is, as he said, it's a tough gig trying to figure out what the central banks are doing. I mean, the central bankers themselves, like their last RBNZ decision was split down the middle, 3-3, and there was a tie break with the new chair. So if they're not completely certain where rates are going or what the next move is. How is it? It's difficult. But no, I suppose learn to expect the unexpected. That's been the theme, hasn't it? Particularly for a certain man in the Oval Office. And the market continues to be very soundbite driven, right? And that you saw that over the last sort of few months. There'd be a comment about, I think you had some of them on your tweets, but bombing the crap out of Iran, or the Strait must open, and then oil would be down and markets would be up, or oil would be up and markets would be down. So that's been quite interesting, I think. But I suppose it has been a little bit surprising in a way, or that shouldn't be, that markets have snapped back so quickly. So at record highs for a lot of indices. But when you step back and think about it, Warren Buffett, you mentioned the book, which I think is a great book as well, said that wars and geopolitical events are expensive distractions. And he's basically saying, look, we invest in companies, not countries. And so I made a point about cash flows and earnings. So it shouldn't really surprise. What's perhaps surprising is the ongoing investor behaviour to those drawdowns. So, and we're our main thing is KiwiSaver. So we're the sixth biggest KiwiSaver provider in New Zealand. So often when those sort of events happen, you get people emailing in or ringing in going, should I change my fund type? Should I go from aggressive to conservative? Just rinse and repeat. And those sort of behaviours that are really sort of problematic, because if you do that, like you don't know when the war's going to end, or when But it's not just individuals that do that. So I was on Ausbiz it was actually during March when the war was really kicking off, and there was a professional fund manager from Australia there saying, I'm going to put all my clients into cash. I'm going to try and time this thing. I thought, are you serious? Like, that's like 101, right? We're probably going to come to it, but trying to time the market. So that's been quite surprising. But the behavioural reaction, and to your point as well, Howard, about better financial literacy, I think that's so important as well. Particularly in that sort of process of trying to build wealth.
Yeah, actually, you're very good at segueing, Greg, because I'd like to leave a few moments for some questions. So I'm just going to get you guys on this last topic, which is pretty key here in New Zealand. Trying to get Kiwis out of property and into other investments, getting them to diversify. Where do you think the best risk-adjusted opportunities are in the next couple of years, 3 to 5 years maybe? And actually, Howard, you also made a point, could you over-diversify? So maybe if I could just start you on the first and then get you to address that.
The over-diversification is interesting, and I won't talk out of school, but we had a customer come to us. He wasn't our customer, but he wanted to move from another broker. And at Tiger, what we do is if you're moving shares to us, we will pay some of the transfer costs. But obviously, the first question was, well, what size is your portfolio? Not that it matters, but it was of interest. And he said it was $60,000, and which is a reasonable size portfolio. It's pretty good. And I said, okay, well, that's fine. And then we asked the question, well, how many lines of stock does the 60,000 Kiwi dollars cover? Because each line of stock, might be an Nvidia or an Apple, it's a different company, and the costs to transfer those are slightly different. And he said 93. And I said to one of my guys, I said, 9? And he goes, 93. Now, I'd be hard pressed to run 93 names of companies I could name on stage. To me, that is over diversification, because it must have meant that he had $500, $600 in some of these companies, and diversification is great, whether it's across different companies or across different sectors or across different asset classes. But 93 lines of stock in a $60,000 portfolio. I mean, you probably haven't got 93 lines of stock in one of your funds.
So that's going from the extreme of having all your wealth in the family home.
Exactly. So I guess I'm digressing a bit, but I think you do need a diversified portfolio across an asset class. I think property is always been a good investment in New Zealand. I think, and I do agree with my friends over here, I think it will remain so, but I think it's had its day in so far as they were saying, just buy it and it'll go up. So I think, it's moving right across the asset class.
Anish, what would you like to see Kiwis get into a bit more as in terms of an asset class in the next 2, 3, 5 years?
I think the first step is probably starts with education, and in terms of what do I invest in, that's the main question people ask. Essentially, the answers that lead on from that creates a portfolio that you can essentially design for yourself, which insulates you from risks like property price movements or general macroeconomic shifts, where you could invest in other sectors which are growing, for example. So in terms of diversification, I think it's a very healthy option for investors or property holders to look into, whether that be some sort of exposure to US markets or some sort of exposure to markets in Hong Kong or Singapore, for example, or through the Middle East, where we're seeing a lot of growth too. So it's important to not put all your eggs in one basket, as it were, but also try to create some sort of portfolio that diversification promotes risk mitigation in terms of insulating yourself, as I said, from exogenous risks that are not in your control. Diversification is good, and to the point Howard made about over-diversification, of course, that comes down to personal greed and probably a lack of understanding of what the correct pathway is forward. So those key kind of middle points about how much is enough, where should I be putting my money, that all really comes down to education and personal choices. So hopefully that answers that.
Yeah. Greg, last word to you. Obviously, we've all got KiwiSaver now, or hopefully we've all got KiwiSaver, so we've got a bit better here in New Zealand about understanding investing. But what would you like to see people get more into?
I actually like to see people save more.
Just save more.
Genuinely, and I think there's awareness growing around this, and maybe it's not so relevant to everyone in this room, but super, the age is probably going to go from 65 to 67. This NZ Super might not even be around when some people in this room retire. There is a massive sort of shortfall for a lot of people. Massey University says you need $1 million if you're a couple in a suburban area to live a comfortable retirement, and I think a lot of people are underprepared. So whether it be through long-term investing, whatever, but build wealth for your retirement as well, and your kids' retirement. You deserve one. So raising contribution rates, we're getting a little bit political here, but we have got an election coming up. We'd like to see contribution rates go up towards 6 plus 6 or 12%. That would mirror what Australia has, obviously a different sort of framework. So I think that would be really important. But back to your question about diversification, you can certainly over-diversify. Optimal numbers probably around sort of 30, 35 stocks. That's what some studies have sort of shown. I had a client 20 years ago in London. He had £1 million, and he came and he goes, I've got a diversified portfolio, I've got 120 stocks in it. And I looked at it, and he had 100 mining stocks. I said, this is sorry mate, this is not actually that diversified. And we laughed, but the same thing actually happened in the dot-com boom. You actually had professional money managers with diversified portfolios that were full of just tech stocks. And I think this time around is completely different, and you sort of touched on it earlier. Actually, everyone sort of had one anecdote, so kind of squeeze one. And you had your one about the Bitcoin moment. Yeah. So I was in Ireland in 99, 2000. I was actually commuting between London and Dublin, and every week without fail, the taxi driver would give me a stock tip, and it would be like something. Have you invested in this XYZ.com? What does it do? I've got no idea, but it's up 100% since last week. I don't see that now. I think it is different now. Yeah, that was priced to eyeballs back then. But I think what also will be fascinating, this next stage of the AI boom, which I sort of agree with how it is. We're just really scratching the surface on AI. Less than 20% of US firms use AI in terms of its theoretical capability. We're just literally a pinprick. So I think it's going to be fascinating to see how it evolves, not just in the tech sector, but it's spreading into other sectors as well, whether it be healthcare, whether it be education, and it will have, I think, implications well beyond just investing in wealth, but so that's going to be really fascinating over the next sort of few years.
Great. Now, I am conscious that it is 1:20, which I believe is lunchtime. So we might have a quick 5 minutes for questions. Yeah. Do we have any questions from the floor for the guys?
Do you reckon there's a case to be made that a little bit of knowledge can be a pretty dangerous thing when it comes to investing? There's a lot of people that really overestimate their own knowledge when it comes to things like this, and I'm sure you've seen many examples of that. But is there some people that just should stay away from learning about these kind of things because they know they're going to get themselves in trouble?
I'm just going to repeat that question because probably some people down the back didn't hear. I think to summarise, is a little bit of knowledge a dangerous thing? Whoever, jump in, whoever.
Yes. Yeah. It is definitely, it comes down really to your own personal appetite, I think. And if actively trading or DIY trading is something that you try and it's not for you, it's important to recognize that this is not for me, and perhaps look at other asset classes, or let someone else manage your funds, for example. But you're right, it's not for everyone. But it is certainly an unbelievable adrenaline kick if you make some money on a nice stock. Yeah.
Yeah, I think definitely a little bit can be dangerous, but that's not to say you shouldn't learn and actually know. If you've got a sizable portfolio, it'd be good to have an idea of what that is. I think the contrary to that is that, and as you say, Anish, the importance of getting advice is, again, it's well documented how important it is. So financial services studies showed that people that had advice had 52% more in their KiwiSaver. So that's a pretty hard statistic to go against. Retail investors underperform the benchmark over 20 years. So you can go, there's literally hundreds of these sort of studies that should have backed those up. And emotion comes into it. I talked before about people trying to time the market or panicking. They see all the headlines, they see what Trump's tweeting or Xing or whatever, and they react. So yeah, but advice, certainly no problem having that knowledge. But in terms of using it to build your wealth, I think you really lean on the amazing access to advice we have in this country. 28% of New Zealanders get advice. That should be higher, but it's a lot better than overseas. Australia, I think, thanks to their regulation there, it's 1 in 10 Australians can get advice. In the UK, it's 9% of Brits get advice. We've got a wonderful access. A lot of cases, it's no obligation. It's free. Yes, we have trial commissions and the like. But it's there, use it, lean on it, and there's some wonderful, the financial services industry in this country is wonderful in a lot of ways, and I think people could perhaps appreciate that.
Those are interesting figures. Do we have any more questions? Yes.
I'm seeing a lot of young people look at the cost of living and ability to buy a home and forcing themselves to take riskier strategies like meme stocks, crypto, alternative assets, Pokemon cards, all that kind of stuff. Does the number of young people doing trading without fundamentals, does that cause systemic risk to the market?
I don't know if everyone heard that, but Daniel's asking, does the number of young people taking lots of risks without understanding the fundamentals pose a systemic risk to the market?
That's an interesting question. I don't think it does yet, but if you look at what happened with GameStop, that was a company that had no fundamental basis for making the movements it did. It was solely driven by retail traders, and a lot of fund managers got badly caught with that. So as far as that stock went, I guess you could say, yeah, it had an effect, but I don't think it's a systemic effect yet, but we'll see. I think the markets, I don't know, it'd be interesting to get Greg's comment. The markets are probably too deep for that, but it may change. Huh?
You're completely spot on, Howard, I think. And those meme stocks, whether it be GameStop or Robinhood, which I think is down like 90% or something since the peak. A lot of retail investors have got burnt. The stock market's at record highs. So, I don't think it's a systemic risk. It's certainly a problem because you've got a lot of young people that have burnt a lot of wealth, just punting basically on GameStop. So, but in terms of, and if you look at our market, I think one of the main discount broking platforms here, like it's Tesla and SpaceX probably now and Rocket Lab. But the markets are just too deep to be influenced by that at this point.
I would make a comment on the younger generation coming into the financial markets. I think they're a lot more financially savvy than people think. Do a lot of work with the universities, Auckland Uni, Wellington, Canterbury, and a lot of the investment committees there are really advanced, and they understand complex financial products. They understand the portfolio diversification topics. So it's quite an informed new generation of trader and investor that we do have domestically. And I think that's also mirrored globally. For example, the average demographic of our client base in certain parts of the world is 20 to 30 years old. We're seeing a lot of adoption into the financial markets. When I go in to speak with universities, we ask for a show of hands of who actually actively manages their portfolio, and everyone raises their hand. So it's quite fascinating to see. I think there are so many more tools available, and the younger generation are very hungry for yield, whether that be Pokemon cards or side hustles or the prediction markets, as it were, as well. There's quite a fascination on all these new technology advancements, and what I do see, and a good barometer for me, is my younger brother's WhatsApp chat group, which I'm lucky to be a part of, and they're a bunch of 18 to 21-year-olds all talking about stock picks, and they're generally very spot on. So it's really refreshing to see, and I do think the next generation of traders and investors will be a lot more informed and will help to carry that onto the generations beyond them too.
All right. Maybe just a quick one. Richard.
Might be a quick one, sorry, but a question just about risk-adjusted returns. So a lot of funds hold up their returns, and they're looking at, we beat these other funds. So it encourages younger investors to actually look for maximum returns in certain shares, particularly in the US. And actually sometimes people are better off. There's some amazing New Zealand companies where you're getting a really good return, you've got a very low downside, and we're talking about long-term wealth, generational wealth. Sometimes those companies are actually far more suited to newer investors who can actually compound their wealth over time slowly, rather than trying to chase these tech stocks where it could be, you could have an amazing return for a quarter or a year or 3 years, and then suddenly take a haircut from 50%. So what's your view on that, and how do you talk to people about risk-adjusted returns?
So we're proponents of diversification. So we run diversified funds, but we do have quite a sizable weighting towards New Zealand and Australia. And I suppose it's not a particularly sexy market for a lot of investors. The Kiwi market. We've got Infratil, which is a data center landlord, but we don't really have those big tech, flashy, shiny names. We've got boring companies like Fisher and Paykel, which make a lot of money. Great exporter. We've got some amazing, defensive, boring gentailers. We've got some wonderful companies. And interesting, if you plotted the NZ50 versus the MSCI World since the inception of NZ50, we're actually ahead. Yeah. As you know, so at the last few years, we've lagged a bit. We haven't had that. We didn't rip higher this year on the rebound. But I think look, as a touch on right at the start about about where interest rates are going. I think the New Zealand market could come back into its own. Where our economy, it also often a reflection of how the economy, our exporters are doing well because the exchange rate's low and that's helped them. But if we want to really lift I think our appeal as a market, we need more companies for a start. Maybe you can help there actually, but also if our economy can get back on that turnaround path, and I think we're going to have a much better 6 months if this conflict is truly over. We're a heavy oil importer. If the RBNZ chooses not to raise rates and maybe even decreases them and proves all the banks wrong again, then that might be quite good for our market. But risk-adjusted returns, we actually do think there's still really good risk-adjusted returns. Per what Nathan was saying, globally we've got around about, if you look at our most popular fund, was got about $5 billion in it. Our Focus Growth flagship fund, that would be around about 60% global equities, split between Nathan's fund and another bottom-up fund. So we see great risk-adjusted returns offshore, but there's a lot of great companies here as well.
I would just add to that. I think the NZX here domestically are very forward-thinking and very pro companies doing well. There's a lot of money in New Zealand. There's a lot of fund managers that have mandates, as you know, for Kiwi companies. And generally, Kiwi companies do quite well that are listed on the exchange. And that passive KiwiSaver flow helps them to recapitalize and invest in new projects, and then new announcements, new products. All are very positive signals. Companies like Main Freight, which I follow, is run very, very well. It was a great little chip mining company called Raycon. You know, Raycon, they had a little acquisition and an interesting rally. But you find these little gems here which are fascinating. And hopefully our story of listing and going public can help others as well get onto the ladder and that market to continue to expand, because there's an abundance of liquidity here and people sometimes don't realize that.
Howard, last word.
Yeah, I think that's right. On our platform, probably about 80 to 85% of our customers would trade the American markets. We trade the NZX. We don't trade a lot of NZX, but it's really interesting because I've just been up to Singapore and Hong Kong and done an investment seminar. And maybe it's the usual Kiwi thing. We don't know what we've got, because you talk to offshore investors, they see New Zealand. We talked about geopolitics. It's very stable. We're 12,000 miles away from everything, which, if we remember, being 12,000 miles away was a real problem 10 years ago. Now it's an asset. So they see us as stable geopolitically. They see us with some really good companies, as you mentioned, you know, healthcare, the Jen Taylors. So there is a lot of investment interest offshore to come in here. So I think, you know, it is a typical Kiwi thing. We always sort of don't see what's in front of our face sometimes.
Greg, Anish, and Howard, thank you very much.